It's 1:30 p.m. in Lagos, same time in London, and we're bringing you markets, business, and insights on Business Incorporated. Hear it from Lagos, Channels Television, live from the HQ. Here's what's coming up on the program. Egypt's PMI for non-oil private sector rises to highest in 22 months. Zimbabwe declares end to 19-hour power blackouts. And Nigeria plans to repay $500 million Eurobond debt this July. Welcome to Business Incorporated. I'm Will Evang. Let's get right to the markets, and we're starting with Africa, where sentiments were mostly positive at intraday. We see Nigeria's NGX recovering from the loss, the 1.99% loss yesterday, 0.84%, back to the 61,000 level. And South Africa's GSC on the flip side was down 0.61%. Let's look at Egypt and see how they traded at intraday. We see 0.04% uptick for Egypt, and Kenya was positive in yesterday's trading activity, closed in the green, 0.4%. Now let's go to the Middle East and see how they performed at intraday for major equities. We see the UAE, the Abu Dhabi index, was up 0.18%. And then looking at the other side, Dubai, however, was down more than 1/3%, 0.31. And then it closed at 39,000 points. And now we're seeing Saudi exchange in the green, 0.07%, and the Qatari index also up 0.18%. Now let's go over to Europe, where China has been battling the rest of the world for a while now, and it's, the battle for the chip production. But we have Lars here to give us the latest insight. Lars Alta is with Deutsche Welle to give us what's happening there. Lars, what's this latest restriction we're seeing from China? Can you tell us about that?
Well, thanks for having me. Germanium and gallium are metals most people only know from studies of the periodic table back in high school, if at all. And now here's a few details. Gallium is somewhat similar to aluminium, and germanium belongs to the carbon group, and both are used in making semiconductors, specifically high-speed computer chips that are used in the defense and renewable energy sectors. Among technologies that rely on gallium and germanium are fiber optic cables, but also night vision devices and satellite imagery sensors. Now, both of these elements are relatively rare, and for both, much of the world's known deposits happen to lie in China. A few numbers here. China produces around 60% of the world's germanium and also much of the world's highly refined gallium.
Why is China taking these steps?
Well, as I said, both of these elements are used in the production of semiconductors, and that is where the alarm bells go off. Semiconductors, of course, are at the center of China's trade battles with the US as well as the EU. Both of these major markets are heavily investing right now in their own semiconductor infrastructure in an effort to be less dependent on China one day. After all, China has long produced almost all the chips needed for the computer, but also the car and the electronics industry. But every effort made by the US and the EU to strengthen their own companies, and that has included in the past export bans for, let's say, chip-making equipment. Every of these efforts has been met with a strong response from China, and this now is just the latest response. If other countries try to slow down China, Beijing hits back immediately. And it's easy for the country to do that, especially since it doesn't only control major companies in the sector and talent and patents, but also resources that the rest of the world simply can't do without. So China is sending a very strong message here, saying that it holds all the cards when it comes to inputs to the semiconductor, aerospace and automobile industries, and that they also make it very clear, of course, that they can and that they will inflict pain on US companies if Washington tries to lessen China's role in the world economy.
So how are markets and businesses reacting to all this?
Well, initially, when news came out that China would restrict exports of those two elements, germanium and gallium, companies were racing to secure supplies, especially as some industry suppliers worry that curbs on rare earths could follow next. The question is now, where can companies get enough resources to keep making their product? One thing is certain, even though China is a major player in the field, it is not the only one. Small amounts of gallium, around 10 metric tons last year, were produced by Japan Japan, Russia, and South Korea. And even Germany has produced it in the past, and it has announced that it would restart primary gallium production. As for germanium, Canada extracts the material out in the British Columbia region, and there's also a few US and Belgian companies involved in that field. Now, companies have also been looking into ways to substitute these elements with other materials. Gallium, it appears, can be replaced by silicon or indium, and zinc selenide can stand in for germanium in some applications, however, at the expense of performance. That is, according to some experts here in that sector. Now, for businesses out there, it's probably best to find a way to cooperate with China and understand that a worsening trade war over semiconductors could be disastrous.
Thanks, Lars. We'll see. Keep us updated on this trade war between China and the rest of the world. Now, we move on to Asia, where Asia-Pacific markets were largely lower as investors digest the release of private surveys on services activity from the region. Services activity in Japan and China remained in expansion territory for the month, while the pace of growth softened in Japan. Nikkei 225 fell 0.25% to end its session at 33,338 points, and the topic slid fractionally to 2,306 points. South Korea's Kospi, however, lost 0.55%. Now, Greater China markets fell, with the Shanghai Composite down 0.69% to close at 3,222 points, and the Shenzhen Component lower by 0.91%. Hong Kong's Hang Seng Index fell about 1.6% in its final hour of trade, and Australia's S&P 200 fell 0.35% to close at 7,252 points after the Reserve Bank of Australia held rates at 4.1% on Tuesday. Now we'll move over to the U.S., where stock futures inched lower early Wednesday as Wall Street looks to resume a holiday-shortened week. Dow Jones Industrial Average futures fell by 0.33%. S&P 500 and NASDAQ 100 futures dipped 0.43% and 0.58% each. Markets were closed Tuesday, as we all know, for the 4th of July holiday, the Independence holiday, and they were closed early on Monday. On the economic front, we see traders are watching for May factory orders data out later today after the market opened. Meanwhile, economists polled by Dow Jones are anticipating a rise of 0.6%, which would be greater than the 0.4% increase the previous month. Investors are also expecting June's Federal Reserve's minutes at 2 p.m. Eastern Time, which could shed some light on the path for interest rate hikes going forward. Now let's check out global oil prices, where prices eased early on Wednesday, pairing the previous day's gains as fears over a global economic slowdown denting fuel demand outweighed expectations of tighter supply due to output cuts announced by top exporters Saudi Arabia and Russia for August. Now, Brent crude was down 0.12% at $76.16 a barrel after climbing $1.60 on Tuesday. U.S. West Texas Intermediate WTI crude futures were at $71.28 a barrel, up 2.13%, having traded through a U.S. holiday to mark Independence Day without a settlement. Now let's bring in Uche Paragon, senior commodities trader at CCI Institutional Trading, to give us more insights on the market. Good afternoon, Uche. It's good to have you on the program.
Hi, good afternoon, and thank you for having me.
Now, Uche, we've seen what prices were trading at earlier. So tell us what the charts are telling you about oil prices today. What direction do you see it heading?
I think it has been positive this week. Since Thursday last week was when the positivity started. After the production cut announced by Saudi Arabia and Russia, the two OPEC leaders. So in our trading firm, we saw the significant changes in the price, because earlier Tuesday and Wednesday last week, the price was bearish. It was negative. But after the announcement, there was a rebound. And early this week, that was on Monday, we also saw a significant rebound in the price. And yesterday, there was also much more significant rebound. However, today, it has not been so, because, as you said, the Brent crude is showing a little sign of bearish, and the market, like the price dropped a little, but we are not really sure that the bearish will have strong impact, because we are expecting a report tonight and also a report tomorrow from the EIA to know what the quantity of supply will be for the traders. So it is only when we see the reports coming up today and the one coming up tomorrow that we can be able to determine the next price movement. But I think we will experience more bullish trend, of course, I think.
Okay, bear in mind, while we wait for that report, Saudi Arabia on Monday said it would extend its voluntary output cut of 1 million barrels per day to August, while Russia and Algeria volunteered to lower their August output and export levels by 500,000 barrels per day and 20,000 barrels per day, respectively. Now, it looks like investors are not reacting to this, or could we see prices react deeper into second half of 2023?
The oil leaders, what they are thinking or the politics they are playing is to stabilize the price of oil. Like as I speak to you this afternoon, the UAE prince, like the minister of oil and UAE, just made a confirmation that the production cut is good to stabilize the price of oil. So we are all looking at a stabilized oil price where the price of oil will be at a bullish price, not at a bearish price, like at a very good higher price. Like as you can see, currently it's trading at $76 per barrel. WTI is on $71 per barrel. We are all expecting that. And the last week there was a production cut, like a supply cut, about 9.7 million barrels supply cut. So it means what we are expecting is actually what is happening in the market. All of them, all the global oil leaders and traders all over the world want this oil to stabilize and they want it to be at a higher price, honestly.
So what's the best strategy to trade now in the oil market now? Could natural gas stage some kind of recovery soon?
Yeah, I'm expecting that, like this weekend, there's a strong heat wave in Europe that they have forecasted that. We have summer in Europe and other parts of the world, so which means the demand ought to have been reduced, but there's a very significant growth and demand surge also. The price of heating gas is most likely going to be high. The Russia and Ukraine crisis was also a significant, showed a very strong impact on oil price. I don't think this year that we will experience a bearish trend in oil, both in natural gas, heating gas, different and other instruments, honestly. And when it comes to oil per se, you will also discover that there's been stability. There's no much disaster, the one as much as we had during the pandemic or any similar thing. There has been stability since after the pandemic. It has rose from $5 per barrel to almost $100 and something per barrel. And now the strategy we are only trading this time is demand and supply strategy. So we are trying to weigh the quantity of supply and the quantity of demand. So that has been the analysis and the strategy that's being applied these days. It's no more natural disaster or any form of other incident that is kind of bad or something that could affect the price.
How do you see this trickling down to Nigeria's oil and gas space? What do you think about oil prices, especially gas prices for Nigeria? Do you see it going lower?
Nigeria is part of the community. Anything that affected the global price will affect us entirely. But like I said, as long as the price remains high globally, it will also affect us positively. I don't think it's going to be a problem. But, the crisis we have internally based on the supply of those who trade on, like, you know what I mean? Like the local supply of the local consumption of oil byproduct. It's not really something we could use to judge the global price of the oil, honestly. So we cannot use, I would call that internal market issue, which does not have strong effect on the global price. But if you're talking about production from oil, from Nigerian aspect, like the proper production of crude oil, then we could now try to relate it with the global trend, try to understand the changes or the impact it's going to make in the price of oil. As long as the price remains high, everywhere, all the countries that produce oil and that trade on oil is also going to benefit in it because the price is one everywhere. It's also what is being traded on the international market everywhere.
Thank you so much, Uche Paragon, Senior Commodities Trader, CCI Institutional Trading, for sharing those insights on the program.
Thank you so much. Thank you.
Now, after the break, we'll be looking at Nigeria's economic growth path. That conversation next. Stay tuned. This is Business Incorporated. Welcome back. In the past weeks, Nigeria has taken some bold steps in economic reforms. There was the removal of fuel subsidy and unification of exchange rates, all in a bid to get the country back on an inclusive growth trajectory. These steps have been commended by the international community. However, factors such as high inflation and interest rates still hold sway. John Ashburn, global economist, Emerging Markets Fitch Solutions, joins me now. Good afternoon, John. It's good to have you on the show again.
Good afternoon.
Now, the World Bank has upwardly revised Nigeria's expected GDP growth for 2023 from 2.8% to 3.3%, and this comes as from the reforms that the current government has undertaken. However, how do you see the expected increase in inflation that is that's projected to be high to impact the overall economic outlook for Nigeria?
Well, it's an important question. In the short run, it will certainly be painful. So if you look at any numbers that we have available, it's clear, of course, and everyone watching this will know this, that fuel prices have risen very substantially already. They'll probably continue to, if not rise further, then remain a lot higher than they were earlier this year. The exchange rate, of course, has also pushed up the price of some imports. So clearly the push factors on inflation are strong and strengthening. So inflation was at 22% in May. It will certainly be higher than that over the coming months. It wouldn't surprise me if it goes towards 30% as we come towards the middle and the end of the year. So that's going to be a big shock to the economy, a big hit, unfortunately, to consumers yet again. But even so, I think I'd agree with the World Bank view there, which is that this is a difficult, a painful process, but on the longer term, it is moving things in the right direction, and it does create reasons for optimism about the economy as a whole.
Well, still on inflation, we're seeing that the U.S. is expected to raise interest rates. That's what some experts are expecting when it meets later this month. Can you tell us how much of an impact this possible rate hike, if they do raise rates, will have on Nigeria, especially amid this current Naira float that we're operating now?
Certainly. I mean, as you say, that is the expectation of most economists. That's the expectation of us here at Fitch Solutions. The rate will be raised by another 50 basis points, another half a percentage point. The actual effect on Nigeria itself probably won't be all that strong. It will put a bit more pressure on the Naira. But to be honest, I think the factors really moving the currency in the next few weeks are going to be more driven by oil prices, by inflation within Nigeria, and by global pressure. So it will add a bit of pressure to the Naira, perhaps weaken it a bit against the US dollar. But as a whole, I think it will probably not be one of the key concerns for the economy as we go forward into the middle and the later part of 2023.
So what projections are you at Fitch Solutions making for Nigeria? What do you see? Do you agree with the World Bank? You did say you agree with the World Bank, but what are your own projections for Nigeria, especially?
So our forecast for 2023 is still at 2.8. So we're a little bit less optimistic, but I'd say the risks are certainly that we're being too pessimistic there, that things go up. And I'd say that we certainly think the growth will pick up next year. So we're very optimistic about growth in 2024, growth of 3.6%, maybe even 4%. So I think where we might have any kind of disagreement with the World Bank is more on timing than on direction. So it's certainly the case that Nigeria's economy will accelerate over the coming months. I think the question is whether that happens in the latter part of this year or if it doesn't happen until we get into the earlier part of 2024. But the direction of travel, I think we're all agreed that things are probably moving in a much stronger direction than they were a few months ago.
Okay, so Nigeria has just gotten, the approval. We've gotten a new loan from the World Bank to the tune of $800 million. How do you see this? Do you see Nigeria avoiding a debt trap here, or do you see us ending up in one?
Well, the debt issue is obviously very, very troubling in Nigeria. The problem that the country is facing with debt payments exceeding federal revenues in many cases is obviously very worrying. There are a few countries in the world where that's true. It's not a good group to be in. One thing I'd say positively is that the removal of the fuel subsidy opens up a lot of opportunities for the federal government. So that removal is going to save the government something along the lines of 3 to 4 trillion naira that would have otherwise been spent on the subsidy that now can be spent on something else. That's money that can be redirected, hopefully some of it towards social programs for individuals. It can be directed towards investments in capital spending. It will also reduce the amount the government needs to borrow. So the debt situation in Nigeria is obviously very delicate, and that's something we'll be looking at with great seriousness over the coming years. But I'd say that the biggest decision the government's made so far, which is on the fuel subsidy, is a step in the right direction and does free up some money in a way that will make the federal government's budget process a bit easier as we go into 2024. So there is progress there, but you're absolutely right to say, in a delicate position, and even in the best of circumstances, Nigeria's fiscal position in 2024 and 2025 will still be very difficult. There'll still be high debt payments. We're hopefully seeing a situation in which the situation improves, but this will be a slow, gradual turnaround.
Thank you so much, John Ashburn, global economist, emerging markets, Fitch Solutions, for sharing those insights on the program.
Thank you for having me.
Now, still on Nigeria, the country says it plans to redeem a $500 million Eurobond this month as the country continues to battle multiple economic challenges. According to data from the Debt Management Office, the DMO, the $500 million Eurobond loan obtained 5 years ago at a coupon rate of about 6.37% per annum due for repayment in July is in line with its terms. This is also not the first time Nigeria is repaying a Eurobond following the 2018 and 2021 and 2022 repayments. Last year, the country repaid $300 million, and in 2021, it repaid $500 million. Nigeria continues to operate a 0% default rate at a time when fellow sub-Saharan countries like Ghana have defaulted and renegotiated loan terms. Now we'll move over to Egypt, where the Purchasing Managers Index, PMI, for the non-oil private sector rose in June to 49.1, up from 47.8 in May. The figure is the highest since August 2021, according to Standard & Poor's S&P Global report. However, the report states that the reading remains below the threshold of 50, indicating a deterioration in business conditions. Output and new orders experienced drops in June, although at weaker rates. On the other hand, inflationary pressures cooled slightly to a 16-month low and remain significantly softer compared to January. And in Zimbabwe, the cabinet has declared an end to power outages, which at their peak lasted for 19 hours daily, halting businesses and the economy. This follows an announcement by state-owned Zimbabwe Electricity Supply Authority to end load shedding. The power utility recently completed rehabilitation of 2 units at its thermal-fired plant in Owange. An additional 600 megawatts has been added onto the national grid. The Southern African nation has faced a severe power shortfall over recent years, which it blames on a rise in economic activity, particularly in mining, as expansion in the sector fuels high demand for power. And that's a wrap on Business Incorporated. Do join us tomorrow for another edition. I'm Will Ibang. Thanks for watching.